Good morning to everybody if you are in the US, and good day, good afternoon to our participants from all over the world. I'm Nicholas Borneos of Capital Link. I would like to welcome you to Capital Link's webinar today on the dry bulk sector. I would like to thank you for joining us. We have overwhelming attendance. I think the topic and the timing are spot on. We have a great group of panelists with us, the CEOs of major dry bulk companies. And I would like to thank Randy Giveans of Jefferies for being the moderator. And of course, you know, we all, Randy just had his second daughter. So we officially give our congratulations and best wishes to him. He's actually on paternity leave today, but he's taking time for the webinar. So thank you, Randy. Thank you, Martyn, Aristides, Hamish, and Loukas. Randy, the floor is yours. We'll do a Q&A, a discussion, and then we'll take questions from the floor.
Awesome. Well, hey, thank you so much, Nick. Thank you, Capital Link, for the opportunity. Yes, and just excuse the bags under my eyes. It's been a long week, but all good on that front. So without further ado, if I can just have each of the four panelists just give a quick introduction, their name, their title, and their company, and maybe what sector or subsector asset class their company focuses on, and then we'll run through some dry bulk supply and demand questions. So Aristides, let's start with you.
Right. I am the CEO of Eurodry, which is a bulk carrier company. We own 7 vessels, and we've been listed as Eurodry for a couple of years, since 2018. But Eurodry was spun off Euroseas, which was a listed mixed fleet company for about 20 years. So we're one of the eldest companies that were listed on the US capital markets. I continue to be a CEO in Euroseas, the container company.
Awesome. Hamish?
Sure. I'm Hamish Norton. I'm the president of Star Bulk Carriers Corp. And we have 116 dry bulk carriers, about a third Capesize and Newcastlemax, about a third Panamax and Kamsarmax, and about a third Supramax and Ultramax. So we span the size ranges in dry bulk above handy.
Excellent. Martyn.
Hello, everyone. Martyn Wade, CEO of Grindrod Shipping Holdings. We own and control 35 ships, of which 3 are tankers, MRs, and 32 are handies and Supramax, Ultramax. And we're owners and also operators, sitting on some 7-8 million tons of cargo a year, and also listed on the NASDAQ since 2018.
Excellent. And Loukas.
Good morning. I'm Loukas Barmparis, president of Safe Bulkers. Safe Bulkers is listed in Europe Stock Exchange since 2008. We have 42 ships, mainly a part of 4 capes. We have Panamax, Kamsarmax, and post-Panamax vessels.
Awesome. All right. Well, hey, thanks for that introduction. Yeah. Obviously, what kind of currently is a little counter-seasonal. A lot of strength in the first year, January off to start, pretty much across the board for dry bulk equity, obviously the dry bulk rate side as well. So starting with demand, dive in. Right, obviously the China demand is pretty high. Steel production is pretty high throughout. Iron ore inventory in China are very manageable, right? Not all those, but still not high. So with that, are iron is good, high iron ore, good or bad for dry bulk shipping? Thin line or an so Aristides, start with you on that. For the iron ore demand, how is?
Yes, Randy, I couldn't hear you very well. I wonder if the others in the panel could hear. Could you all hear, guys, well?
No.
Maybe Randy, if you don't mind, repeat your question, because it came a little bit
I heard the question, but your connection is not very good.
All right, I'll grab some headphones, but while I do that, if you can answer the question, Chinese iron ore demand, how is that?
Sure. Well, the Chinese iron ore demand has been growing every year. And even last year in 2020, despite the coronavirus issue, we saw a huge increase overall in iron ore imported into China. It increased by about 9% overall. The first quarter was slow, but after the first quarter, we had a significant increase in the imports of China, which had to do with the Chinese economy overcoming the COVID issue very quickly, having put in these measures to improve their own economy with infrastructure works, which helped. Plus also, they even started exporting more steel than previously towards the end of the year. This has led to significant price rises in the commodity, which are also seen in the price rises in steel, in the finished good produced. This indicates that the demand is there, and of course we think that this is something that will continue into 2021 as the rest of the world also starts getting over COVID, hopefully sometime in the summer. And we feel that all these trillions that have been put into the global economy by the banks, the federal banks, to support the economy, are finding their way into the markets slowly, and will result in a very significant growth in steel requirements within 2021. Therefore, we believe that this is one of the areas that will benefit tremendously this year. The part of the question says, what do we think about the rising prices and how these might influence demand? I think the rising prices indicate the need of the commodity. I don't think that we will see a slowdown in the trade because of the rising prices. In fact, what I think we will see is all the iron ore producing countries trying to increase their production, and therefore having greater volumes that will be shipped. So overall, I think this is a very positive thing. The higher prices will also lead to higher investments in new mines. So I expect that this will have a lasting effect going forward in the improvement of the market.
We lost
Randy.
Randy.
So anybody want to add something on what I said, since we're trying to find Randy?
Sure. I guess, I would, just add that, iron ore prices are high, but steel prices have been rising. And so, Chinese steel producers, even though they have to pay a lot for the iron ore, are getting a lot for their steel, and their profitability has continued to be strong. So as long as the steel producers can be profitable, high iron ore prices are really just incentivizing the producers of iron ore to produce more, which is good for dry bulk.
Sure. And let's touch on
and sorry, Randy, can I just add there, the other interesting thing that freight as a portion of the iron ore price is at a historical low.
Got it. Right. No, that is certainly
So
fair. Iron ore being
freight, we can go a bit of a way yet before I think we have any impact on the iron ore price or steel production costs.
okay. Loukas, I'll turn this one to you. Speaking of kind of the producer, we saw in the news the fire at the Ponta de Madeira facility in Brazil. How are Brazilian exports flowing? I know Vale's had some issues. What is the kind of market coming out of Brazil right now with the fire and without?
Look, I think that this fire will have a marginal effect on the operation of the facility. Of course, it will help probably a smaller size vessel than the LOCs like Capes. I mean, it will benefit, I think, the next couple of months. But then the production will and the exports will continue as normal. I think they will be quite fast. The important thing is that, and we need to pay attention to that, is that we have a strong market ahead of us coming out of COVID-19, which hopefully this will happen during 2021 in the first half. And the people will come out, the economies will try to be back, and we will, and supported by all these programs that, let's say, China has, and maybe the United States will also have in the near future. We will have a good support from the demand side, and because of the supply side of the vessel is quite limited, I think we'll have good markets during 2021.
Sure. All right. And then if you look at kind of what's going on with China, Australia, Martyn, if you can answer this one, just looking at the tension there and the impacts on dry bulk shipping, I know they're kind of turning away coal and really any imports from Australia. How has that been impacting the dry bulk shipping as of late?
I don't want to get too excited, but fantastic. And I hope it lasts for the rest of the year. With La Nina, you've got Northern Europe, Northern China in particular, in Northern China, Northern Asia, having incredibly cold winter. A lot of the countries, China, Korea, Japan, short on coal, LNG prices through the roof. With Australia blocking China, they're getting their coal from elsewhere, Colombia, South Africa. There's even Ultramaxes out of the Black Sea. And in return, Australian coal prices, of course, have halved and probably some of the cheapest in the world. So Australia now is obviously importing a lot into India, Bangladesh and places, but also to Europe. So we've got a double whammy on this. So law of unintended consequence, yeah, long may it last. So I think it's very, very positive. Yeah, seems like that inefficient market is boosting ton mile demand, right? And we saw that with kind of the U.S.-China trade spats and these other. All right, looking a little longer term, I guess, China, they continue to say in their 5-year plan, they want to build some more infrastructure, build some iron ore mining overseas, right? And kind of accelerating those projects. Why is that kind of diversification of the iron ore supply for China? Why is that so important? And how would that impact the dry bulk market maybe in 5 to 10 years? So, Hamish, you want to give that one a go?
Yeah, sure. Look, at the moment, Chinese iron ore demand is primarily served by Australia, which is a pretty short trip. Sure. And, the Chinese are trying to diversify their iron ore sources away from Australia. First of all, that means that Brazil will take share. And anytime Brazil takes share of the iron ore market, that's great for dry bulk because Brazil is almost 3 times as far away as Australia. But, African iron ore sources or potential African iron ore sources are also quite a bit farther away from China than Australia is. And, look, if Australia starts serving the European iron ore demand and Africa and Brazil take share, serving the Chinese iron ore demand, that's another situation where, you know, ton miles are just increased as, you know, people take the, you know, the least efficient routes. You know, and when people take inefficient routes, that's great for dry bulk.
Yeah, no, that's fair. Hey, Loukas, can you give us some insight on coal, right? We've heard a lot about coal getting attention on decarbonization, renewed focus on the environment. So I guess two questions. What are your expectations for maybe global coal demand in 2021? And then more importantly, the global kind of ton mile demand for shipping coal, right? They're not always the same. So if you can kind of shed some light on that.
Look, due to decarbonization, the long-term prospects of coal, I mean, when we say long-term, it will be longer than, I mean, after 10, 15, 20 years towards 20, 30, 40s. The trade will be gradually stabilized or even reduced. However, for the shorter period ahead of us, the coal is a very important fuel in any energy mix of several countries, especially in China. And we see, for example, that when we have, let's say, a cold weather somewhere, and maybe sometimes, as it happens, maybe the LNG price is going up, the imports are increasing. So I think that coal in the short term will continue to be a very important commodity for the shipping, for the dry bulk shipping, while in the long prospects after, let's say, 10 to 20 years, the importance will be reduced. I think that decarbonization is very important, and also we strongly support all the measures by IMO or European Union towards decarbonization, because this will, I mean, we need to participate in this part and do our share.
Okay. All right, two more demand questions. This one to Aristides. Chinese demand for soybeans, right, surged during 2020, likely looking pretty strong for 2021, as obviously the Chinese swine herd kind of recovers from the African swine fever a couple years ago. So given this increased needs for imports, what are your predictions for Chinese imports of U.S. soybeans this year under a new, Biden administration?
Well, Randy, it's difficult to say exactly what will happen because it will depend on the discussions that will be held regarding U.S. trade with China. We all know that the Biden administration is probably going to be much more in favor of globalization than certainly Mr. Trump was, and the continuation of sharing the benefits of globalization within the whole planet. I think are much improved today because of the Biden administration. So this is a very positive thing for trade globally. I think that also with China we will see an improvement in the relationship, but this cannot be certain. However, grains, soybeans, all these agricultural products that are used to feed the people and are more used as the people get richer and can afford all these commodities. This bodes well for the dry bulk industry because the planet is growing, we have more people. I am pretty sure that we will see increased trade, not only with China, but everywhere in the world with all these agricultural goods. And as you correctly said, we had a dip last year due to the swine flu, which killed a huge amount of the Chinese swine fleet, let's say. that has recovered to pre-swine flu levels. So I think everything looks quite positive for next year at least.
Okay. And then I guess last question on demand, and I'll open this up to anyone because it's probably the most important question, right? In about 3 weeks, you'll see Chinese New Year. Historically, it's been a very slow time for dry bulk shipping, right? Rates kind of trend lower into it, stay weak during it, slowly rise out of it. 2021 seems like it could be different, right? Do you believe that it will be different? And if so, why? Open to the panel.
Can I start there? It's already been announced.
Martyn.
So it's already been announced by China that they're staggering Chinese New Year. They can't afford, when you think logically, to have 700-800 million people moving around the country with corona. So they've already announced it's going to be staggered over actually several months. Factories will remain open and they will do it in a completely different manner. And I think this is maybe where people have been getting it wrong. This assumption that the market will now fall off a cliff. I don't think from an economic point of view they can afford it, nor can they afford it from a corona perspective. So what we're picking up, it might ease a little bit, but this is going to go through. It's going to be like no other Chinese New Year.
Well, any others?
If I may add that we are already, 20th of January, nearly the 20th of January. The dry bulk market usually at this stage is very slow. It isn't this year. We have the highest dry bulk market of the last decade in January up to now. This is an indication that there is demand there, there's a lot of demand there, and we're not following the usual pattern where things slow up during the European Christmas and the Chinese New Year period. I think that there is a lot of momentum here that will gather within the next couple of months, and coupled with what Martyn said, we will see a pretty stable market during the next couple of months.
Okay.
I think that everybody is quite positive and for 2021, and we must be positive because it's a unique situation where we see several things happening at the same time. From one side, the order book is limited. The financing, several banks from Europe have left, so the financing is limited. So the supply side is very well controlled. From the other side, the demand for transportation, it looks that it will increase during the year because of several support that several banks around the world are, let's say, printing money, and they are providing additional funds to the economies. I think that, as I said before, the time that the people will come out again after this, let's say, situation of distress, which had closed us for, let's say, several months. It will be as if a war is finishing, like the Second World War. Everybody will go out for 1 or 2 years. Everybody will be happy, will be ready to spend. The states provide the support. So I think that we will see very good shipping markets ahead of us in 2021, both from the supply side driven and the demand.
Yeah. And I wouldn't underestimate the impact of oil prices, the benefit of high oil prices to the dry bulk market. It's something that people don't pay attention to often, but charter rates in the dry bulk market are more or less proportionally affected by increases in the oil price. When bunker rates go up, there is pressure on the fleet to slow down. And the only thing that keeps the fleet from slowing down are high charter rates. And if there's a demand for moving these dry bulk commodities, the charter rates have to go up to accommodate that demand for shipping services. And, you know, with the vaccines being distributed and demand for jet fuel and other oil products going up, oil prices have been strong, bunker prices have been strong and getting stronger, and that's pushing charter rates up. So
Yeah.
that's going to continue, we think.
For sure. And Hamish, I'll come back to you on kind of fuel spreads and things like that in a few minutes. But back to Loukas, you kind of mentioned it, segueing into the supply side of the equation. So I'll start this question to you. You know, obviously we have kind of IMO 2020 behind us, but now you have some regulation, environmental uncertainty around IMO 2030, right? And kind of future regulations impacting shipping. So how is this affecting your fleet renewal process, and thoughts on that?
And look, it's quite tricky how to approach this issue, and we have
That's why I asked you.
Yes, I know, and we have done a couple of orders. So the idea behind ordering is renewal of the fleet, not expansion. And we know that there are two important limitations that will be introduced in the next, let's say, 2 to 3 years from now. The one is the so-called Energy Efficiency Design Index that requires the new builds to be by 30% more efficient compared to 2008 emission regulations. I mean, until now we have 20% lower, and we will move to 30% lower, which is something. But also there's another indicator which is called carbon intensity index that will be introduced, and this will measure the actual emissions of the vessel. So it will be a measure of grams of CO2 emitted per ton per mile. I think this will give a clear picture to the, to everybody how polluting is the ships, and will introduce probably through schemes which could be energy taxation or carbon taxation in several countries, including the European Union, and maybe with Biden administration it could also be United States. So the polluter will pay. All this will introduce probably slow steaming in order to achieve these limitations. And I think that this will be a good prospect for the longer part of the cycle, longer throat of the upper part of this cycle that could last maybe not for 1 or 2 years, maybe it could last for 3 or 4 more years.
Got it.
So I think this is important thing, and we have done our exercise, and we are in this respect, and we're not intent to order too many ships. I mean, the company's thesis is to gradually renew the fleet with modern energy efficient ships that will be able to last for the next, let's say, 15 to 20 years.
Got it. And then following up on this and turning over to Hamish for a second, you know, what are your thoughts around new buildings? Is that a good idea or pretty much a non-starter at this point? And before you answer that, I know there is a pretty large gap, right, between a new build price and a 5-year price. Seems like the disconnect there is pretty in favor of the secondhand acquisition. And I also know Star Bulk recently purchased, right, 3, I guess, 10-year-old Capesizes. So your actions may answer the question, but that said, kind of what are your thoughts on that? New builds versus secondhands, and kind of where do you view them?
Well, we're not brave enough right now to order a new building in the face of environmental regulations that are clearly, let's say, unstable. You know, in the old days, when you ordered a new building that was legal at the time you ordered it, it was grandfathered in for its entire useful life. We do not have faith that at this point, if you order a new building that's legal today, that it will be grandfathered in, you know, for its entire remaining useful life. So we want to wait and see what the political environment looks like, what the regulatory environment looks like. And, you know, what we're seeing in terms of the actions of other ship owners is that a lot, if not maybe almost all the other ship owners are taking the same attitude. They're waiting. They're seeing what the regulations end up requiring. They're seeing what sort of engine they're going to need to use. They're seeing what sort of fuel they're going to need to use. And so I think across all sectors of shipping, you know, dry bulk, tankers, container ships, you know, you name it, there's going to be less ordering than you would normally have while people figure out what kind of ship is the ship of the future.
Yeah.
And that's great.
And yeah, for sure. We've seen that in recent months and quarters. Just look at the, you know, in our recent quarterly, our Jefferies Shipping Outlook, we included the order book to fleets for all subsectors, right?
Mm-hmm.
And pretty much all the charts were down and to the right, right? So the order book to fleet ratios are very low. And a lot of it has to do with that kind of regulation uncertainty.
Yeah.
Now let's look at the other end of the equation. Martyn, I'm going to turn this one to you. You know, looking at scrapping, obviously there were a lot of breaker yards closed down during 2020, maybe some pent-up demand for older ships during 21. That said, the back half of the year was pretty elevated in terms of scrapping, at least in the dry bulk sector. But now you're also seeing Bangladesh paying up to $500 a ton for scrap steel. So with that, will 2021 exceed the 15 million deadweight tons or so that we saw in 2020 for dry bulk scrapping?
Interesting question, because obviously the steel price is sky high, scrap price sky high, yards having to pay up. Traditionally, in a rising market, very few owners scrap. But going to what Hamish said, of course, it is new regulations. And if you're getting $500 a ton for a 15, 18, 20, 25-year-old ship, this is good money. Or you can risk going forward. So I suspect that it might just surprise on the upside against proper convention, normal convention, because I think owners are going to face this. If we continue trading, more and more problems with ESG, is it worth the risk? And at $500 a ton for an old ship, make the most of it.
Yeah, there's certainly three main variables in scrapping, right? Your steel price, your scrap steel price, day rates, and fuel price. Scrap steel is going up, fuel prices are going up. Now, day rates are also going up, so we'll see how those kind of balance out here in the coming months. Aristides, turning to you. You know, shipping dynamics in 2020 were pretty much all about COVID-19, all about economic recovery in China. Obviously, that was the very clear winner. Now, what other markets, kind of on a regional trade, are you most hopeful to see for a recovery in 2021?
Firstly, let me say something about scrapping, because
Sure.
I really think that we will see very little scrapping because we will see high charter rates. I think that we will see high charter rates and very few people are going to be scrapping their ships despite the high scrap price. I can speak for ourselves. We are both on the container and on the dry bulk sector, the company having the elder ships. And our calculation is always extremely simple. Is it worth passing the next special survey, or is it not worth passing the next special survey? Do I do it for another 2-3 years of trading, or do I not do it? And if the market is good, you recover the dry dock cost, including the installation of the ballast water treatment plant, quite quickly at markets of $15,000 a day. So I think we will see very little scrapping. Regarding the areas where we could have a growth in trade, I really think that the Far East is the area which has is going to be growing faster than the rest of the world, and where we will be seeing more need for vessels. I don't have any particular area that I want to say that is going to jump and surprise us. I don't expect surprises. I expect China to be the strongest importer by far, more than 50% of growth. We had about 60% of growth of iron ore this year came out of China alone. But we will see India, Vietnam, or the Far East will be the strongest area, I think.
Yeah. All right, that's fair. All right, so I'm taking notes here. I've got Martyn with the over on 15 million deadweight tons for scrapping and Aristides with the under. So we're going to circle back at the end of the year and we're giving out a prize. All right, another group question. I'll leave this to everyone because it touches on all of your companies, right? Starbulk has the largest fleet of kind of Cape sizes and Newcastle Maxes. We'll throw those in among the group. Safe bulkers, you certainly have some exposure to the largest asset class, while Eurodry and Grindrod, do not have any. So given a hopeful sustained global economic recovery in 2021, what are your thoughts around maybe operational exposure or lack thereof in this largest kind of Cape size segment? Whoever wants to start, feel free.
Well, maybe I can start. We're pretty optimistic about the Cape market. The Cape market is very dependent on steel. And so that, basically boils down to being optimistic about the steel market. The steel industry is experiencing a strong recovery, as COVID-19 hopefully starts to disappear. Iron ore ton miles are, we think, growing. As Brazil slowly takes share, as China looks to alternatives to diversify away from Australia, that's going to, we think, boost ton miles of iron ore significantly over the next few years. The supply side looks great. Looks great. The order book for Capes is at an all-time low. The overaged VLOCs are being retired from the market, and Ponte de Madeira is retiring them maybe even a little quicker. As I think one of the panelists pointed out, Ponte de Madeira is not able at this point to load VLOCs in one of its berths, and that may take a while to fix. We think 2021 is going to be a strong year for Capes. The FFA market has started to reflect this, and we'll see what happens, but we think it'll be good.
Martyn or maybe Aristides on the kind of non-Cape size. You okay without Capes?
Very happy. We were in Capes a few years ago. Happy now. We like the Handies, which has an even more positive outlook in terms of order book. And at the end of the day, yes, you obviously, China producing steel, but also any infrastructure spending in America, it's going to be cement and steel, which is Handies and Supras, Ultras. Grain. The other thing, everyone talks about soybeans, that the outstanding US corn sales, 29 million tons still to go in the next 7 months. That's all in the smaller sizes. And I think that the whole world has changed to a degree. Globalization is alive and well, but supply chains have changed. Instead of just in time, I think we're now getting just in case for an awful lot of commodities. And this filters into the smaller sectors. So we're very happy. Maybe we won't get Hamish's 150,000, but tell you what, if we get 25, 30,000, we'll be very happy.
Noted.
Yes, I think that obviously the bigger the ship, the bigger the return in a very good market. So Capes can really perform extremely well if the need for iron ore is big. So I can see a good recovery in Capes, and we don't have any Capes, but we will of course see the same kind of recovery in Panamaxes and Kamsarmaxes, which also transport a lot of the iron ore. but also Ultramaxes from what Martyn said. We know that the markets move more in parallel, but so when the market lifts for capes, it always also lifts for the smaller vessels. The opposite doesn't always happen, but it happens many times. What we don't like, and it has perhaps to do a little bit with our size, is the fact that when you have capes, you are relying on one commodity and one customer, which is China, and that can create huge volatility. And shipping is a very volatile business anyway. So we were kind of happy having, you know, the medium sizes from Supramaxes up to Kamsarmaxes, and being active in that market. It's big enough to give good returns in a good market, and small enough to have less impact in a bad market. So,
sure.
Yeah.
All right. I have one more question for each of you. Loukas, you want to say something? Go for it.
Yes, I agree with Aristides. I mean, we are happy to see the Cape market to be strong, because also this mitigates to the smaller vessels. I mean, from our side, the majority of our fleet is, of our Cape fleet is fixed at higher prices than the market, but still we have, let's say, some exposure in the spot market, which is very nice to have, let's say, better profits. So we are quite happy to have that.
Okay. Yeah, one more question for each of you from me, and then we have a litany of questions on the Q&A side. So, Loukas, while I have you here, you know, there certainly has been a kind of Brexit, right, a private equity exit from dry bulk recently. We've seen that from, you know, some vessels being sold into Star Bulk, buying out some private equity partners. We've seen that from private equity investors selling shares in Genco and others in recent weeks. So how will this impact kind of future financing needs and also kind of public equity trading volumes?
Look, I think that private equity has a different scope and a different horizon of investing. So at certain point of time, they need to materialize their profits. But shipping business is a little bit different. The financing, I think, is from our point of view, is that we don't mind if private equities participate in shipping companies. Of course, everybody has the right. But I mean, once in the far past that I was in New York. I mean, one private equity asked me, what is our exit strategy? And what I said is that our exit strategy is that we don't have exit strategy from shipping. While, for example, a private equity has an exit strategy for shipping. So, I mean, Safe Bulkers and our team is here for, let's say, for the following, for several following years, hopefully, to try to play the shipping market itself and not mix it with other, I mean, with other needs that, let's say, the financing equity markets are need to do. This is very important for us.
All right, thank you for that. And good kind of segue to the next question. I'll flip this into Aristides. You know, you mentioned, Loukas mentioned around the exit for Safe Bulkers from dry bulk is non-existent. Now that hasn't been the case, you know, with another peer, Scorpio Bulkers. Obviously, they've exiting dry bulk, going into WTIVs. We've also seen some diversification away from dry bulk from one of your peers, Navios, right? NMM bought out or merged with NMCI. So Aristides, your company, you know, Eurodry, on the dry bulk side, you have Euroseas on the container ship side. What are your thoughts on kind of consolidating the two, or just consolidation in general, as well as on some of these companies kind of diversifying away from dry bulk?
Sure. Well, firstly, let me say that both these examples that you gave of diversifying away from dry bulk or merging containers with bulkers came at a time when the decisions were taken at a time when the dry bulk market didn't look positive at all. So that's when these things were initiated. about 6 months ago, something like that, when the market was lousy. I think that both the companies might have regretted this decision, because the prospects now look good for dry bulk. And if Scorpio wanted to do to make an investment in something else, they could do a different investment, a completely new investment. They felt that the dry bulk didn't have a future. I think this has changed over the last 3 months, and people are more optimistic about it. And also talking about the Navios containers merging into Navios, I think, again, that reflected the need that Navios had for some increase in equity, and the containers were starting to go extremely well, and they decided to merge them in order to help, the mother company. But, and I say that because I am convinced that the markets do not want to have mixed fleets. We were a mixed fleet. Euroseas was a mixed fleet for over 10 years of dry bulk and container ships. And I can tell you the markets didn't like it. The day we separated the two companies, the day we did it, the market capitalization of both companies added together was 50% higher than what it was prior to the separation. So I am convinced that the markets like to see focused companies, and the investors can choose if they want to invest in dry bulk, in container, in whatever they want to do. So that's one thing. On the other hand, I do admit that the size of our companies, both on the container and on the dry bulk side, more on the dry bulk side, are relatively small to take the get the full advantage of being in the capital markets, because there is an advantage, and we've been talking about this many times, no need to repeat the arguments, but there are advantages of being listed, and for a small company to be able to take advantage of all these things, we should grow the company. So the intention is to grow, and if that is with a merger or something like that, it's something that may happen in the future. But it's definitely worth being listed.
Yeah, no, that's fair.
And focused, yeah.
All right, Martyn, I'll finish with you, but before that, Hamish, coming to you on fuel spreads, right? You are the scrubber guru, for lack of a better term here, I guess your company, Starbulk, right? So what are your thoughts on kind of the fuel spread this year? Obviously, we've seen some expansion recently, comments around scrubbers. A year ago today, scrubbers were the best thing since sliced bread, right? $300 a ton spreads. It was just incredible. This summer, people were laughing at you, right? Oh, those scrubbers, we knew they wouldn't work. The payback period's 20 years, yada, yada, yada. Now, $100 spread, you're starting to see a little bit of kind of tick up. Oh, these scrubbers could be profitable again. So all that being said, what are your thoughts on scrubbers? You're pretty much committed to them now. What is your outlook for them this year?
Well, the market right now for the spread between low sulfur and high sulfur bunker fuel is about $100 a ton.
Yep.
And, that's basically the market now. We think that the market will get better than that over 2021 as basically jet fuel and other low sulfur transportation fuels increase in demand. We've covered already, something like half the cost of the scrubbers.
Oh, wow.
Because we did hedge a bunch of fuel spread at the beginning of 2020, end of 2019. And, I think we'll cover the rest of the cost of the scrubbers in 2021, if not, in fact, more than that. And then after that, it's pure profit. So, we think it was a good decision, and it's contributed a lot to our earnings in 2020.
Yeah, no, that's fair. And right, as an economic recovery kind of continues, you'll certainly see more demand for jet fuel, less supply of VLSFO, more supply of HSFO as these refineries start running further. So we're with you on kind of a spread expansion throughout 21.
Yeah.
Martyn, I'll start this question to you. This will be my last question. We have some on the Q&A, which I'll get to in a second. And then others, feel free to chime in, because this is arguably the most important question of the panel, right? We have a lot of investors on the line, a lot of people interested in dry bulk now. We're seeing this counter seasonality. We're seeing the strong outlook, both on the supply and demand side. So with that, pretty much all of your shares have doubled in the last, let's call it 2 months, 2.5 months. Is this the start of something great, like we've seen in 2016 and maybe a few times prior to that? Or have we kind of moved a little too far too fast? Kind of, how do you view your stock price currently? What are some drivers and catalysts for further share price appreciation as we get longer into 2021?
I think it's only the start. I think share prices like ship values got destroyed last year during Corona. Since Q2 to the end of last year, ship values on the dry cargo side didn't really recover very much, according to the brokers, and yet the market doubled. I think we're now seeing that with new building prices up 5%, secondhand values arguably going to be up 10% this quarter. And with that, the NAVs, and yes, we have moved up, but still well short of NAV. And I think what investors maybe need to be reminded about shipping this time around, and yes, we've got to start making profits. It's got to be all of us. But this time, there is no capital program for anyone. There's no new buildings. There's no scrubbers. So if and when we do start to make money, pay down some debt, I think we can become dividend paying, because what are we going to do with the cash? And we're hardly going to go and invest in new buildings, as Hamish said, for what or whatever. So maybe, like gold mining companies, throwing off cash, and maybe that shipping's going to have its day again. But we need to be profitable, and from that point onwards, it'd be a nice position to be in.
Yeah.
Fair. Others, please chime in.
And just, just to give you a sense of the profitability, and Randy, you're familiar with this, but we have about 40,000 ownership days in a year. So $1,000 a day in charter rates, that's $40 million. And $1,000 a day, that's not so much.
Sure. We've seen bigger moves than that in a single day, right?
Yes.
Clearly.
Yeah.
Loukas, Aristides, any comments?
Yes. Loukas, go ahead.
Okay, thank you. Look, in the last decade, I think the dry bulk had suffered a lot, and nobody could argue differently on that. I think it's a time that we can see some better markets, and we believe that still there is a room, and we will see it in the future, that asset prices of vessel asset prices will increase. I think this will support better valuations for stock, and similarly, as Hamish said, with whom also I agree, that gradually profits will start being built, and so we may have a good, certain good opportunities ahead of us. You see that we're discussing about the price that the stock prices doubled the last few months, but imagine that we were at very low, unprecedented levels the last year. So it's not that it's the prices increased suddenly or doubled from a regular or a standard point. They were as low as to levels that we have not seen. So I think that it's a correction towards a more reasonable price level for all shipping stock. And it's not that the stocks became too expensive suddenly.
Yeah, that's fair.
Yeah, and may I say, the 2000 to 2010 was a very good year for dry bulk, extraordinarily good year, a good decade for dry bulk. 2010, 2020 was the opposite, an extraordinarily bad decade for shipping. And it followed the extremely good times that came before that, and the fact that so many investors got so excited about shipping in generally and dry bulk in particularly, that they poured in with new buildings, with new ideas. This has gone away. We don't have all these investors now building new ships. So we've got a very controlled order book. And I think that we are going to have a decade. I'm not saying it's going to be like the 2000 to 2010, which was one extreme, but 2010 to 2020 was the other extreme. Between the two extremes, there is a huge difference. And if we are just in the middle, just in an average period, I think we're going to see extremely good levels for most of the companies. Most of the companies became too levered because of the halving of ship values, let's say, and the halving of the revenues, or more than halving of the revenues. Now, if this just goes back to normal, if we can say there exists a normal, but goes back to median, let's say, that will result in prices of stocks that are close to the NAV or around that level. And the NAV has room to go up from the extremely low levels that it was last year. So I'm quite optimistic. Euroseas, our own company, we've been public for 16 years. We were giving dividends out for 8.5 continuous years. Then we've had 7 years that we have not been able to give dividends. And this, I think, might change this year. We will see. What we need in order to continue to see a good market and see a further improvement is the charter markets to remain decent and hover around median levels. I'm not talking about extreme levels. If we're at median levels, I think we will see good profitability of most companies.
Awesome. Well, yeah, thank you for that. And yeah, I joined Jefferies Shipping Equity Research in 2011, right? So coming off the great decade, and I was told, yeah, this decade's going to be, it wasn't a great decade. It was fun. It's been great, but obviously not for the equity. So hopefully this upcoming decade, as you all mentioned, could and should be much better than the previous, and I'll be here for it. So now let's turn to Q&A. We have about 12 different questions. So let me start. 2 of them are around the Australian-China kind of tensions we mentioned earlier, and I'll put them together. One is, do you expect the Australian-Chinese tensions to mitigate here in the coming months? So I guess for China to lift that unofficial ban. And if so, what do you expect to happen with day rates in both the Capesize sector and the Ultramax sector with that restrictions kind of being lifted?
I don't necessarily expect restrictions to be lifted. You know, I expect the ships that are stranded off China to find other places to deliver their coal. And
Okay.
then that will bring some ships that have been basically out of the fleet waiting to figure out what happens back into the fleet. But, you know, I think that Australia is going to have a harder and harder time to deliver coal and even eventually iron ore to China. And that actually is going to be good for dry bulk. It's an increase in ton miles. The Australian products will go further to find a market, and the Chinese will have to go further to find coal and iron ore. It's, you know, that's up to them, but it's great for us.
Sure. So that ban being a good thing. And we touched on that earlier with the expansion of ton mile demand and inefficiencies and port congestion and all these things. All right, switching gears, here's one. From the Panama Canal Authority, do you consider the possibility of this trade to migrate to a bigger size vessel above the 70 to 80,000 vessels due to the higher demand? So larger dry bulk ships going through the Panama Canal.
With the Panama Canal, of course, there are certain restrictions, draft, everything else, which you can't get away from. And also, if you look at Panama Canal at the moment, it's fantastic. If you're coming from east to west, I think there's 12 days delay, a number of days going. So they want to put more through the Panama with the delays. It's fine. But basically, that there is a limit, and then it all ties into the price of fuel. What is the most economic way to do it? And both canals, Panama and Suez, they tend to gauge it, and they charge accordingly depending on whether it makes more sense to go around the Cape or the Capes or not. So it can be, but I think the expansion's been done, and I think enough is going through, especially where you have the container ships at the moment getting priority. So big delays. So I don't think from a bulk perspective that's a concern we have. And what was it? Panamaxes were designed, and of the total Panamax fleet, less than 10% actually went through Panama during their lifetime. So.
Yep, that's fair. Scrubber question of the current dry bulk fleet. How much of the fleet do you consider to have scrubbers currently? And do you consider scrubber utilization to be a tendency in the dry bulk fleet?
I can give the numbers, but Hamish can comment on them. I think it's going to be around 25% of the deadweight will have scrubbers, 50% of the Cape-size fleet, and 10% of the Ultramaxes and Kamsarmax fleets on average will have scrubbers. So these are the numbers from Clarkson's, and if Hamish wants to comment on them.
Yeah. And you know, look, people with a scrubber are using the scrubber. You know, the scrubbers are not so difficult to keep working, and people keep them working, and you know, they don't use a significant amount of energy to operate, and you know, it's really just a question of paying back the investment, and you know, that's looking a lot better.
Got it.
Maybe something on that. It's important to recognize because it is very the technology of each scrubber is very important. So certain as we move along, we will see that certain scrubbers that have been installed from, let's say, from a lesser quality contractors will fail, and so the vessel at a certain point of time will need to move to the other fuel, to the compliant fuel. So the question of the scrubber is very important, and is in direct relation with the selection of the equipment, how reliable is the equipment, because it's not a 1 year exercise or 2 years exercise. In order to make profits, you need a reliable scrubber for a few years. So we will see how reliable are the scrubbers in the following period, and how successful each one will be.
Got it. And then Loukas, can you comment on your a question from the audience, your payback period on your scrubbers? I know Hamish mentioned he says almost half of his paid this year, the rest will be 21. I don't think you locked in similar hedges. So where do you stand in current paybacks?
Look, I think that initially, we were never too optimistic about, you know, because if you calculate, if you do the calculations, the top margin, you feel that you will get the money in 1.5 years. So we always thought that we will do something like 3 years as a payback period. Of course, we received also some money at the first stage where the spreads were quite increased. And then we moved to a period where the spreads were low, 70, 65, 75. Still, we're having a payback period on that could go up to 5 years. I think that the payback period, I believe it will be something like 4 years for our expenditure. It will not be 2.5 or 3. It will be, let's say, 3.5, 4, based on the price differential.
That's fair. A couple of quick questions here. We'll run through them relatively briefly. Is it possible for China to diversify away from the Australian iron ore when Australia supplied, 700 or so million tons in 2020? Vale production guidance is maybe 400 million tons in 22. Now, most of that ban is on coal, right? Because maybe they don't need it as much. But any way China can diversify away from Australian iron ore?
No.
Probably not entirely, but probably partially, right?
I don't think so. And it's funny how they haven't banned iron ore, isn't it? It's one of those things. Yeah. So
Yeah.
it may be long term, as we discussed, buying mines, but this isn't going to happen. No, at the end of the day. And if infrastructure in America and Europe gets going, there's going to be demand for iron ore. So I think the Australians have it at the moment, and that isn't going to change anytime soon.
Okay. Another question here. There are many leasing companies, especially in China, which are investing in ships in large numbers. How will this affect, one, the traditional ship owners, and two, the market outlook for charter rates?
Well, the question is how many leasing companies are going to order dry bulk ships on speculation? And,
Sure.
Obviously that is happening to a small extent. But most of the leasing companies are really just acting like banks. And if they don't have clients who want to order dry bulk ships, they're not doing lease financing on dry bulk ships. Basically, there is a demand for additional sources of secured financing because the European shipping bank business is shrinking. We do not see a large number of ships being ordered on speculation by Chinese leasing companies. So I'm not too worried about it.
Okay, that's fair. A few more quick questions here. How do you think U.S. infrastructure spend will affect the dry cargo market?
Through the roof if it happens. Don't want to say anything more than that.
Okay, and that's just from importing steel and cement, or what are your comments around it? What drives that?
It's steel, cement, and ultimately, who has the cement? That's China. So as we saw after Hurricane Katrina, where backhaul became front haul, the sheer volume of cement that went in, what can happen? American steel, they'll have to get steel from elsewhere. Could a deal be arranged with China as a way back that maybe China funds some US infrastructure spending and then it's win-win for both? But yes, it'll be incredibly positive for dry cargo. We wait with fingers crossed.
Sure, I would agree with that. A couple more questions. Do we see LNG or dual fuel engines as the fuel to move in for the dry bulk sector? Obviously, we've seen some container ships with the LNG powered new builds. We've seen some VLCCs on the crude side getting the dual fuel LNG sector or LNG powered new builds. Is that going to happen in the dry bulk sector, or are y'all expecting just to wait for ammonia or hydrogen?
Well, I think we are waiting and seeing. LNG obviously has certain benefits, but there are certain drawbacks as well. First of all, it's still a fossil fuel. It doesn't necessarily solve the political problem around fossil fuels. There is inevitably methane slip, which can occur before the methane gets to the ship, to a great extent, actually, before the methane gets to the ship. It's a problem that might be solvable on the ship, but is not currently solved. And of course, methane in the air is a much more potent greenhouse gas than CO2. So while there have been a few dry bulk ships built with LNG, it's not obvious to us that this is the way forward. And so we're still waiting.
Noted. That's fair. I think we have two more questions. Did labor costs show a meaningful increase last year as a result of disruptions caused by COVID, problems relocating, rotating crews? Where do you stand in that regard? Or have all your crews been kind of offloaded off those kind of stranded ships? We heard seafarers on board for a year, right? And what is your outlook for this upcoming year regarding cost and crew changes and those things?
I think that labor costs, specifically the crew changes and the related costs, were quite increased because everything went up. So tickets and the waiting period in certain ports, I mean, that you had to stay in quarantine for 14 days. So all these things accumulated, and I think that almost all companies in shipping will be affected by that. In our view, I think that this cost is overall a little bit more expensive, but it is absorbed by other parameters of our cost. So I believe that the OPEX will be roughly similar to the previous year. In the future, I think that even this year we'll continue to have, let's say, higher costs for the full year. I don't expect that costs will decrease in relation to crew changes. From our side, from our point of view, we made almost all changes that were required by diverting ships to the Philippines quite often, and do whatever it was necessary, because the important thing is that to maintain let's say, a strong and competent crew on board and not tired crew over, let's say, 10 or 12 months.
Sure. All right, last question. I know we had a robust Q&A here, but wanted to make sure we got them all in. How are the panelists keeping track of the Carbon Intensity Index, the CII, across their fleet? What initiatives have they put in place to improve it, and what are they doing around the ESG front?
Well, maybe I can start.
Please.
You know, we've put out our second sustainability report that's on our website that touches on our environmental efforts, our societal efforts, our governance situation. And you know, we're paying a lot of attention to the carbon intensity of our fleet. We have been looking at you know, what we can do in terms of our engines. We've been looking at route optimization, speed optimization, you know, alternative fuels, basically hybrid power generation on board ships. We've been looking at modifications to our ships, for example, using gate rudders on even existing ships, and you know, propeller modifications. You know, we're looking at everything, and we've got an in-house vessel performance monitoring department that pays close attention to the energy efficiency of the fleet. You know, this is becoming a very high-tech effort, and you know, I think my physics training in my youth is coming in handier and handier as time goes by.
If I may say also a couple of points, I think that as a company, we don't go too much the technicality of the reports, but we have ordered a couple of new technology ships, which are for sure have the best carbon intensity index and the best EEDI index. And an important thing to recognize is the fact that each ship and the technology with which it was built defines its consumption to a great extent. So although certain changes can be done, I don't think that too many things can be done. And there is a great variety out there in the market. And we need to see the ships from which shipyards they were produced. Quite often, let's say, Chinese ships before 2010 were quite inefficient. I mean, in all these ships that were built to be inefficient, you cannot make too much to make them better unless you slow them down. And this is also an opportunity up to a level that can be still competitive. I think that the important thing is always to be at the edge of the technology, to be ahead of the technology. And that's why, and we are quite happy in Safe Bulkers that our fleet is always, I mean, most of the majority of the fleet was built in Japanese shipyards with very good specifications, with generally better efficiencies compared to several other shipyards. And this pays back at the end of their life when the technology changes.
Can I add one thing?
Please.
I think that the whole industry is looking at it very seriously. It's not only a matter of specific companies. It's the whole industry that through the IMO and with the IMO is working quite hard in trying to reduce emissions worldwide for shipping. So this is something that is happening. We all know that we have to reduce emissions by 2030, and work is being done. It's a very aggressive program to try and find how we can reduce them down to zero, which is the ultimate limit. But the industry is working hard for that. And sorry. Is working really hard towards that direction. And all the rules that are being implemented are towards that direction. The MRV requires that every ship records what it emits. So I am very confident that not only as a company, the listed companies are paying even more attention, are coming out with sustainability reports. We will be coming out with our own sustainability report within the next 3 months. They are more open about it, but the effort is within the whole industry, and I think we've understood it well. And it's just that we're really waiting for the breakthrough on technology to enable us to go to the next level.
Awesome. Well, I know that's pretty much it on our end on the Q&A side, but wanted to give each of you 20 seconds if you have any kind of closing remarks, something you didn't say that you wish you would have. So 20 seconds each if you want it. Aristides, we'll start with you.
No, we've covered everything. Go ahead.
All right, Martyn, any closing comments?
I just think we're in for interesting times finally, as Aristides. So we had a wonderful 2010, then we had a terrible 10 years, all markets recover, people getting out now, throwing the towel in, all things considered. I don't want to jinx it, but I think it's we have potential here, finally.
Yep, that's fair. Loukas, what you got?
I would like to wish to everybody good health and a prosperous year. I think that the previous period was quite challenging, and we deserve to have a better period this year, and it looks like that it's quite likely. We as a company, as a management, will continue. We have, let's say, a very strong management team. We will continue to do our business, and hopefully we will make us Safe Bulkers stronger during the next year.
For sure.
I'd
Hamish,
just like to
closing remarks.
remind people that, 40,000 ownership days per year means $1,000 a day drops 40 million to the bottom line.
Starbucks plug, noted. Awesome.
We're all shareholders.
Yeah,
we're all shareholders, Hamish.
Yes. I too am pretty bullish on the dry bulk outlook here. Supply is obviously very low. Demand should inflect this year. So thank you so much for the time to the 4 gentlemen on the panel. Thank you, Capital Link, for the opportunity. Obviously, I really enjoyed looking at you all, but I'd much rather be looking at my 1-week-old. So I'm going to sign off here. And thanks again. Happy New Year. And we'll talk soon.
I'd like to thank you all. It's been a great webinar, very insightful, spot on. On March 2nd and 3rd, we're hosting our flagship spring shipping conference. So last year, it was gloom and doom. It was just as everything was getting locked down. This March, I think, and I will go back to Martyn, who said, let's not jinx it. I think the sentiment is very different. So the title of our conference is Sailing into Recovery. And I think with this, I will again thank you. By the way, our next webinar is on February 3rd on the container market, another booming market. So please log in and don't forget March 2nd and 3rd. Randy, Martyn, Aristides, Hamish, and Loukas, tremendous thanks. It's been an amazing panel. Thank you.
Thanks.
Thank you. Have
Nicholas.
a great day.
Thank you. Bye-bye.
Bye.
Bye.